Yeah. Today, let us discuss about
No,
trading psychology.
ಇಲ್ಲದೆ ಇಲ್ಲ ಸರ್.
So, first of all, what is this trading psychology mean? Trading psychology refers to the emotional and mental aspects that influence a trader's decisions and actions in the financial market. It encompasses feelings like fear, greed, overconfidence, and hesitation, which can significantly affect the trading outcomes. So, here in psychology, we will talk more about fear, greed, overconfidence, hesitation, hope. So, what does this psychology does? So, while trading or while investing in the stock market, the fear prevent us from taking a calculated risk or to exit a position too early. Whereas greed, it it push us to hold on to a position for too long, hoping for more profits, which eventually leads to losses. So, in the same way, the others too, in short, trading psychology is about understanding and managing these emotions to make rational decisions rather than impulsive ones. So why does this trading psychology matters? So what is the definition of trading psychology? This trading psychology, it refers to the emotional and mental factors that influence a trader's decision making process and behavior. So why does it matters? So why does this trading psychology matters? Means trading psychology, it emotions, it affects a decision making process. Uh, and why does this trading psychology matters? Emotions affect a decision making process. Emotions such as panic during market, it can lead to poor decision making because market events are unpredictable. The stock market is influenced by various factors, many of which are out of control. And at this moment, every investor or trader requires a discipline, a proper discipline. And we investor, we must stick to predefined stop losses and profit targets without letting emotions override our plan. So in this, and as here written that even the best trading strategies can fail if a trader cannot control their emotions. As a trader, your mindset shapes how you react to market events. So we have emotional stability versus technical knowledge. This technical knowledge includes reading charts, understanding indicators, recognizing patterns, knowing strategies like scalping, swing trading, or trend. Whereas this emotional stability involves staying calm, focused, and disciplined. Here, technical knowledge gives you what to trade and when to trade. I mean, when to enter and when to exit. Whereas the emotional stability gives you how to follow through on your plan without second guessing. So, in this first, we are we will go through some different topics to understand more about this uh, trading psychology. In this, let us discuss about the core emotions in trading. the core emotions in trading. And first one is fear. Fear, the paralyzing force. So fear is one of the most common emotions traders experience and can significantly impact the trading performance. What is fear in trading? Fear in trading arises from the possibility of losing money. I mean, we will get fear while investing or trading when there is a possibility of losing the money. It will happen when you see a position moving against you. Like, for example, a stock you bought is rapidly declining in value and you fear losing your investment, losing your capital, or you are uncertain about the outcome of a trade. Even if analysis suggests the trade has potential, the thought of what if it goes wrong can hold you back. Or you have experienced losses in the past. Previous failures can cause hesitation, making you overly cautious. And how does this fear impact traders? First one is premature exits. Fear, this can push traders to close trades too early, even when their strategy indicates they should hold on. Like example, I had purchased a stock expecting it to rise, but after a minor dip, fear compels me to sell at a small loss. Later, the stock moves up as predicted and you miss the profits. Or due to this fear, we may avoid trades altogether. Like fear of making a mistake or losing money, it can lead to it can lead to exit. I mean, it can lead to enter into the market. Like we will become so worried about risk that it will avoid us to take any action in the market. Like for example, I will be hesitate to enter a trade despite clear signals, or this fear can impact investor to over reliance on safety. Like fear can make traders overly conservative, avoiding calculated risk that are essential for growth. And how to manage this fear? Use stop loss orders. A stop loss order automatically closes a trade if the price moves against you by a predefined amount, minimizing potential losses. Like for example, if you buy a stock at $100 with a stop loss at $95, if the stock falls to $95, the order closes the trade, limiting your loss to $5 per share. And sticking to a trading plan. A trading plan outlines our entry, exit, and risk management strategies. Following it helps us to make decisions based on logic rather than emotions. And we need to focus on long-term strategies. I mean, zooming out and thinking about the bigger picture helps us to avoid overreacting to short-term market movements. For example, instead of panicking over a small loss today, consider how our portfolio might grow over months or years with consistent strategy execution. And we need to practice more and more. Like we need to first go through some virtual portfolios, which was already available in our ThinkSapio website, or we can try some demo accounts, which can allow us to overcome through fear and to apply certain strategies. And after this, we have greed. This greed, the trap of wanting more. What is greed in stock market? This greed occurs when traders become overly focused on maximizing profits, often at the expense of risk management and logical strategy. It typically manifests in the following ways, like ignoring risk. Traders may hold onto positions for too long, hoping for even higher profits while ignoring signs that the market might reverse. Because the market will never move in our thought process. The market will always move opposite to what we think. But this greed will cause us to ignore signs which will eventually lead to losses. Like, for example, a stock has already risen by 10% as expected, but greed convinces us it will go even higher so that I can hold on only to see the stock drop back to its original price. And it will lead us, and this greed will lead us to chase hot stocks. I mean, we jump into stocks that have already shown large gains driven by FOMO, which is fear of missing out, without evaluating whether it's a good entry point or not. Like, for example, if a stock has risen 30% already in a day and you buy at the peak only to see it crash the next day. And third one, over over leveraging. Over leveraging in the sense we will take excessive positions or we use high levels of margin in hopes of maximizing profits, often without considering the increased risks. Like, for example, if I invest 50% of my capital in a single stock and a small price drop, even if it is a 10 cents, 5 cents, it will result in a massive losses. And how this greed can impact us holding positions too long. Like, greed will convince us that we can squeeze out more profits even when the market shows a sign of reversal. This can turn winning trades into losing ones. For example, a stock which I own hits my target price, but I still hold on it. Finally, the stock drops and I lose all my gains. And again, over leveraging and big losses, chasing after hot stocks, as discussed, like we will jump rapidly into raising stocks without proper analysis, which will often lead to losses. And then over leveraging and big losses, like greed encourages traders to risk more than they can afford, which amplifies losses when the market moves against them. And how to manage this greed? Set clear profit targets. We need to establish realistic profit targets before entering a trade and stick to them. Like, for example, if my target is a 10% return, exit the trade once that level is reached, even if the stock continues rising. Exit when targets are met. Discipline is key. Exiting a trade once our target is met ensures you lock in profits rather than gambling for more. Like, for example, if my analysis indicates a stock is likely to rise to $200, if it reaches that level, exit even if it seems like it might go higher. Like, and avoid FOMO. I mean, FOMO in the sense of fear of missing out. Like, if a stock is rising, in the hesitation, in the fear of missing out, we to invest in that stock as, I mean, not just because of any analysis, not just because of any recommendation, just because it is rising, which eventually leads to losses. At such times, we need to ask ourselves, am I buying this stock because of analysis or just because of hype? And we never have to risk more than 1 to 2% of our total capital on a single trade. And then overconfidence. And again, the greed will eventually lead to overconfidence. And what is this overconfidence? Overconfidence occurs When a trader overestimates their skills, knowledge, or ability to predict market movements, it is usually triggered by a string of successful trades or a favorable market environment. I mean, it will lead us to inflated belief in skills. Like we believe that we can't make any mistakes and we assume that our success is solely due to skill rather than external factors like market conditions. And we disregard all the risk. Like overconfidence makes us to believe that we are immune to losses, and it will lead us to take unnecessary or excessive risks, and it eventually lead us to overtrading. I mean, where we take some unnecessary trades believing every decision will be profitable. And what is the impact of this overtrading? Taking excessive risk leads to taking excessive risk. Overestimating abilities can lead traders to ignore risk management strategies such as setting stop loss orders or diversifying positions. One wrong trade can wipe out gains from several successful trades. And ignoring market signals. Overconfident, it may dismiss warning signs such as declining volume or bearish indicators, leading to poor decision making. And over trading. I mean, trading excessively without proper analysis increases transaction cost and eventually leads to losses. Like when overconfidence leads to unexpected losses, traders often experience frustration and self doubt, impacting their long term performance. And how to manage this overconfidence? Regularly review trading results. I mean, we need to analyze our past trades to separate skill from luck. We need to identify patterns and evaluate our decision making process. Like, for example, if our wins were during a strong bull market, we need to acknowledge that market conditions played a significant role in our gains. And we need to stick to the risk management. Like, we need to always follow our risk management plan regardless of how confident we feel. Like, for example, we never risk more than 2% on a single trade, and we need to take breaks between trades. Like, we have to prevent ourselves from over trading. And finally, we need to seek continuous improvement. Like, we need to I mean, we first of all, we need to concentrate on the process, but not on the profit. And we need to avoid expecting that every trade to be profitable. We need to understand that losses are also a natural part of trading. And we need to focus on achieving consistent results over time rather than hitting home runs. And then hesitation. And this hesitation leads to missing opportunities. What this hesitation means? Hesitation stems from the fear of being wrong or making a costly mistake. It's a cost of indecision that can arise in various forms, like over analyzing situations. Like we spend too much time looking for the perfect signal or entry point, leading to delays. Like, for example, if I see a bullish breakout but waits too long for additional confirmation, it eventually I will lose that trade. And it will lead us to fear of loss. Like past losses, which occurred in the past losses, it can create a fear of experiencing similar outcomes, which paralyze decision making process. Like, for example, after a losing trade, I may hesitate to act on a high probability setup, afraid it might fall again, and lack of confidence. And maybe inexperienced traders or like somewhat new traders in the market, they often doubt their analysis. even when it aligns with proven strategies. And and how does this hesitation impact us? Missed profitable, and this due to this hesitation, we miss profitable opportunities. Like falling to enter trades on time means missing out on potential profits, which will eventually lead us to feel frustrated when we realize they were correct but we didn't act. And it increased anxiety and self doubt. Hesitation creates a cycle of indecision that erodes confidence over time. Traders become more fearful, making it harder to trust their analysis and causing trades to miss market movements. I mean, when traders hesitate, they often enter trades too late, chasing moves instead of anticipating them. They end up buying at the peak or selling at the bottom, leading to losses. And this hesitation disrupts the execution of a trading plan, which will deviate us from our strategies. And how to manage this and how to manage hesitation. Develop confidence in our strategy. Confidence comes from experience and familiarity with our trading plan. We need to test our strategies through practice or simulated trading or virtual portfolio. Like, for example, by using backtesting or paper trading to validate our setup before risking our real capital. We need to trust our analysis, like learn to rely on technical and fundamental analysis, accept that no trade is guaranteed, but focus on the probabilities. Like, for example, if my setup meets all criteria, we need to enter the trade without overthinking, with our risk management in mind. And we need to start small to build. Like, if hesitation stems, we need to start small. I mean, it's not that we enter the market and we invested all of our capital. We need to start small, and after gaining experience, then we may increase our capital. And we need to learn from missed opportunities, and we need to focus on execution but not on outcomes, because worrying about results does not give us anything. We need to learn the process. And then hope, the dangerous optimism. In trading, hope can be a double edged sword. Hope in investing arises when a trader clings to the belief that a losing trade will eventually reverse in their favor. This mindset can manifest in several ways, like refusing to close losing trades. Traders avoid accepting a loss because they hope the market will turn around, ignoring clear signals. Even when market indicators suggest a further decline, we hold on to the stock by believing some false optimism and over reliance. I mean, like we we hope that our judgment will be right. I mean, our rational analysis may become right in the hope, which will eventually lead to losses. And how does this hope impact us? Escalating losses. Like, we need to refuse, I mean, we refuse to cut losses early, which can result in much larger drawdowns. Emotional attachment to trades. Like, hope creates a sense of emotional attachment where traders hold on to positions out of pride or fear of failure. Rational decision making is replaced by emotional reasoning. Loss of discipline. I mean, this hope, it can override a trading plan, leading traders to abandon predefined rules and strategies. I mean, it will eventually lead us to do over trading, and it will and we will eventually become inconsistent. where our risk management, where our risk will increase, which will eventually lead to more and more losses. And how to manage this hope? Stick to stop losses strategies. I mean, we need to predefine a maximum loss level for every trade and honor it without expectations. Like, for example, we need to set a 5% loss for every trade. If the price drops to that level, exit the trade immediately. Be willing to cut losses early. Accept that losses are part of the trading and exit when a trade goes against you. Like, for example, if a trade is clearly falling to meet our expectations, close it and move on rather than waiting for a reversal. And we need to focus on risk reward ratios. Like, ensure every trade has a favorable risk to reward ratio. Like, for example, I'm risking $1 to make $3. And we need to detach emotion from trading decisions. And finally, we have regret, like dwelling on past mistakes. And what is this regret? Regret is an emotional reaction tied to the feeling of loss or failure in trading. It often arises in the following scenarios, like missed opportunities. When traders fail to act on a setup that later turns out to be profitable, it will I mean, eventually we miss those opportunities. And bad trades, I mean, when a trade results in a significant loss, we may feel that we should have known better. Revenge thinking, regret often leads to a desire to recover losses or prove ourselves, which can cloud judgment and which can further lead to more and more losses. And how does this regret impact? As told, it can lead to revenge trading. I mean, we may attempt to recover losses immediately by taking impulsive, high risk trades, increases the likelihood of compounding losses. Overly cautious decision making. I mean, fear of repeating mistakes can lead to hesitation or avoidance of trades altogether. Missed opportunities to grow capital or benefit from valid setups, and loss of confidence, which will eventually lead to loss of confidence. Like, constant regret erodes self-belief and leads to second-guessing trading decisions and limiting future potential. Like, it can, I mean, this regret will will cause frustration, anger, self-blame, distracting from logical trading, a negative mindset that spills over into future trades. And how to manage this regret? Simple, learn from the past mistakes. Reflect on what went wrong, identify the cause, and adjust our strategy. Like, for example, if I missed a trade because of hesitation, I need to focus on improving confidence on my strategy and focus on the next opportunity. Instead of obsessing over the past, concentrate on preparing for the next trade. Like, for example, I need to review my watch list or reevaluate upcoming setups rather than revisiting past losses, and avoid emotional trading. I mean, we need to stick to our trading plan and resist the urge to make up for a bad trade. Like, for example, if I had just taken a loss, take a break to reset emotionally before trading again. I mean, we need to view mistakes as part of the journey to become a better trader. Instead of saying I failed, say I learned to avoid this mistake in the future. Like, for this, we can do like some meditation or mindfulness, and we can take some breaks, which can eventually improve our emotional balance. So, here today we had discussed about the core emotions of trading in psychology: fear, greed, overconfidence, hesitation, hope, and regret. And when we overcome through these six strategies, eventually it can make us a better and experienced trader. And and uh, And in the upcoming session, we will learn about more like there are some psychological biases we have, and then fear of missing out, and how things have you will help you in all this process. In the next session, we can learn. If anyone has any doubt, can you please ask?
Yeah, hi. How to access this recording? Are they on your YouTube channel?
Sir?
Are the recording available on a YouTube channel?
Yeah, it will be available, sir, later.
Okay. I mean, I'm looking for the past video. This is good.
Yeah.
Your past presentations also.
Yeah, sir. It will also be available, sir.
Thank you.
I mean, just like on this session, we had done a some of introduction type, like what is fear, what is greed, what is hope, what is hesitation. Mm, I mean, we have some biases, like how to overcome all these core emotions. Like we have some bias, overconfidence bias, anchoring bias, confirmation bias, hurting, loss aversion, recency bias. I mean, which we will learn more about on the uh, next session in the detailed way. Which can definitely will help us to implement great strategy.
Yeah. Also, I don't know if it is the right time